You're watching Ask Udayan, our special show where we answer all your questions on stocks. With the markets currently as volatile as they have been, who better than our global business editor to take you through some clear strategy and level-headed thinking when it comes to markets at a time like this. If you have a question, do send it to us on the number on your screen. We'll answer a select few every week. Our first query today from Sanjay Agarwal in Gurugram. He's holding Happiest Minds. Let's listen into his query.
Hi Udayan, I'm Sanjay Agarwal from Gurgaon. I'm holding 50 shares of Happiest Minds at the rate of rupees 1144 per share. I seek to know from you whether I should simply hold them as it is, sell them now, or add more at current prices with the aim to average my holdings. I look forward to have your mid to long-term perspective. Thanks.
Well, Happiest Minds is a good company with an excellent promoter and a very good management team. The problem was that it had become too expensive. I mean, you will recall, you didn't buy at the top, but the stock was trading at 1,500 and 1,600 rupees. So the correction that we've seen in Happiest Minds all the way down to 850, 900 levels, from those levels, it's a significant correction, is part correcting with the sector, because the whole IT space has corrected quite significantly because of all the problems of what is going on in the Western world. People have great concerns about whether the kind of demand that we see for IT services will continue. And particularly for companies like Happiest Minds, which cater to the digital segment, there's been a collapse in valuations in the digital segment because of the Nasdaq fall. And therefore, there has been a sentimental impact on Happiest Minds as well. So I think part of it is because of all those issues, and part of it is the very lofty valuations that the company was trading at 55, 60 times. And that had to correct in line with the fear of interest rates going up and the general compression in valuations in the market. Even now, Happiest Minds, after such a big correction, is trading at 35, 36 PE multiple on FY24, which is not the cheapest valuation. And the last quarter's numbers were not bad, but they were, by the standards of Happiest Minds, maybe a little lackluster. But I think it's a company which can still give you about 20% revenue growth and 25% profit growth over the next 2-3 years, if not longer. So growth is there. It's whether the stock bottoms out at a PE multiple of 30 or around these levels, which is a difficult judgment call to take. So I think this stock will need to consolidate for some time longer. I don't know whether this is the right time to average. Maybe you'll find even better price points going ahead. But keep valuations in mind. Otherwise, I think it's a very good company to own in the medium term.
All right, Zubin Daruwala is sending in a query. He is from Mumbai and he has a query on banks and financials. Listen in.
Hi Udayan, I like your show a lot and the way you cover it well. Thanks for it. I had a view, I wanted to know your view on State Bank of India, HDFC Bank and ICICI Bank. Is it the right time to enter in these stocks, or should we wait for a fall further? Thank you.
Well, they have corrected, both ICICI and State Bank of India, from their recent peaks quite significantly. More importantly, they've actually been consolidating. Even good performers like SBI. Last 6 months, I think the stock has done practically nothing. So it's been a range and it's consolidating. And that's because the sector has not just been a complete underperformer. But now I think it's an interesting time for many of these bank stocks, because interest rates will start to go up. They have started inching higher. And one has to take a call on how many of these banks will do in a rising interest rate scenario. Some banks actually stand to do quite well. If you look at an ICICI Bank, the way their loan book is set up, I think they could reprice it quite easily, their flexible loans, and therefore they could actually stand to do well in a rising rate environment. On State Bank of India, that is probably a little trickier because they have a very large government security book, and as interest rates go higher, some of the bond portfolios might not do very well. So you could see some hits coming in on SBI from that point of view. But SBI is not expensive. Given the strength of its subsidiaries, it's still trading at about 1-time price to book after doing quite well over the last couple of years. ICICI Bank has now become about 2.5 times book now. It's done very well over the last couple of years. So I think these are two names which in a good banking portfolio or a good financial portfolio are very essential holdings. Now, the bigger call is whether banks will unwind their underperformance and start to perform well once again. That is a trickier call. I don't have the answer to that, but having underperformed for the last 1 year, I think the two names that you mentioned, these are very good holdings for the long term, medium to long term. The near-term outlook for the next 6 to 9 months is still unclear to me because banks don't seem like the leaders of the market any longer as they used to be a couple of years ago.
Ashutosh Wani has also sent in a query, and Ashutosh is curious about LTI. Listen in.
Hello sir, I am Ashutosh Wani. I had purchased 50 shares of LTI at 6,800. Should I sold it or hold it for long term? Because the merger news are coming out of LTI and Mindtree which were affecting the share price of LTI.
You're right. I think the merger news and the risks which the merger might bring, all mergers come with risks, that is weighing down on the stock. The stock has corrected very, very significantly. I think it's down about 40% over the last few months. So L&T Infotech has taken a bit of a beating. It had run up significantly prior to the merger announcement, of course. So let's see how L&T Mindtree, the two come together, and how long this process of consolidation, integration of operations, and the eventual transition takes place. But they will become a fairly significant force, the two together. They were both well-run companies. Now a management transition is taking place. But they will soon be knocking on the doors of being the top 5 among Indian IT companies. They will be in a position to bid for much larger deals. In the past, that has been an issue, but now they can go for those big $250 million, $400 million kind of deals as well. It's a fast-growing company. If you put the two together, they will probably be trading at something in the ballpark of 23, 24 PE. Not cheap, not the most expensive either after the correction. So I think it probably makes sense for longer-term investors to be patient with this management and probably wait for a while to see how this merger pans out. I wouldn't be in a hurry to dispense with the holding immediately on L&T Infotech. I think it's a fairly high-quality company. Yes, IT stocks are correcting right now. There is an overhang out there, and it might take a little bit of time for that overhang to clear. But I think longer term, given the demand metrics, given the kind of strengths which both these companies come with, moderate valuations, and the tailwind of the currency, I think this probably is a good combination, L&T plus Mindtree, to hold on to in your portfolio, in a high-quality technology stock portfolio.
All right, let's also take a look at some of those pharma names. Harsha has a query on Lupin. Let's hear him out.
Hi, this is Harsha from Bangalore. I bought Lupin shares of 180 at 998 rupees. Shall I sell it or hold it? Thank you.
I'm not a big fan of Lupin, I'm sorry to say, because, it doesn't strike me as the best in-class pharmaceutical stock to own in India. But I think most of the frontline players are probably better placed than Lupin. And Lupin's performance is nothing to, even if you look at the last quarter's numbers which went by, margins were poor, there was hardly any sales growth. The US business, which is the bread and butter for Lupin, it's seeing continuous price erosion, and that business is degrowing. India is better, the India portfolio, but no great shakes either. And you look at the stock, Lupin is down 50% from its all-time high. You look at the last, I think the stock peaked in 2015, and 7 years have gone by, and the stock is down about some 50-60% from those levels. It's been a wealth destroyer, frankly, over the last 7 years. So the period running up to 2015 was good for Lupin, but somehow it seems to have lost its way with growth over the last 5-7 years. And I don't see the stock really bouncing back in a big way and rewarding shareholders. So in pharmaceuticals, you can pick many other higher, faster growing companies, and I would say that you can think of at least 5-6 Indian pharma companies which are much better placed than Lupin at this point in time. So it's been a star in the past, but I think it needs to revisit or refine that zest which seems to have lost over the last 5 and 7 years. It would not be my top of the heap in Indian pharma at all.
All right, that's about all we could squeeze in on today's show, but we will continue to take those queries week on week. Udayan, thanks so much for taking the time out to answer some of those stock-specific questions. We'll see you again next week. Here's the number on your screen. Do send in your queries, and we'll take a select few every week on our special segment, Ask Udayan.
If you like the video, do like, comment, share and subscribe.